India's foreign reserves crossed the $500 billion mark on Friday for the first time after registering a massive surge of $8.22 billion in the week ending June 5th, aided by higher foreign inflows. According to RBI's weekly statistical data, the overall Forex reserves increased to 501.703 billion US dollars on June 5th from $493.48 billion dollars, reported for the week ended May 29th. India's Forex reserves comprise foreign currency assets, gold reserves, also special drawing rights, and India's reserve position with the International Monetary Fund. In this edition of The Big Picture, we will analyze India's rising forex reserves and what it means for the economy. Joining me on the program today are Dr. Arvind Virmani, Chairman, EGROW Foundation and former Executive Director, IMF. Jayan Das Gupta, former Ambassador of India at the WTO, and S.C. Tripathi, former Principal Secretary Finance, Uttar Pradesh. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Tripathi, let me start the program with you. Let's first try and understand and analyze and put into perspective what forex reserves really are.
Let me recall a little bit of history. In 1988-89, I used to work as Joint Secretary in the Department of Economic Affairs. And among my various assignments was to manage foreign exchange reserves and manage the foreign exchange balance of the country. So in those days, we were already under pressure because the imports were much higher than the exports. And it was quite difficult to keep the reserves above a certain level. The recommended level was 3 months import cover. And my secretary, Mr. Venkatramanan, had given me the charge that I should not allow the reserves to go below a certain level. Otherwise, the confidence of foreign investors, foreign lenders, foreign institutions like World Bank, IMF, ADB, foreign banks, etc., would not be sustained. And therefore, I used to, use all the instruments at my command to keep the reserves, but they were not 3 months import cover. In those days also, they were about 2 months or little less. I left in August 1989, and by June 1991, the reserves had fallen to about 1 week's import cover. So today, it's a happy occasion. And if one has to see the benefits of economic reforms, I think it's one of the most striking benefits is that instead of 1 week's import cover, we have more than 1 year import cover. So this gives stability to our financial system, our, in the international market. Now, people look at India with greater confidence. So both for investors, lenders, and other participants, it gives them a lot of confidence in the Indian economy, in the Indian financial system. Now, the question is, the reserves constitute of what? Basically, we have to see that our foreign trade balance continues to be highly deficit, more than $100 billion a year. So our reserves have really grown because of remittances by the overseas Indians, the exports of IT and such services, and perhaps investments in our stock market. But the secondary market investments in stock can always be hot money. Therefore, this gives also an occasion to look at the composition of our reserves and look at how we can, make our economy more balanced so that our trade also improves.
Okay, all right. We'll look at the composition of our balance in just a bit. But before that, Dr. Virmani, why are forex reserves really rising despite a slowdown in the economy? If you could explain that to us, because you do a lot of studies and a lot of research on these kind of things. So please do tell us.
If you'll excuse me, Mr. Tripathi has raised old memories by mentioning Mr. Venkatraman. In fact, when he was governor, I worked with him. We had proposed the foreign exchange liberalization. And I remember I went to Bombay to work out the final details with him of what we had proposed. But anyway, that was in 91. Anyway, yes. So basically, there are 4 factors. One of them you mentioned yourself. There is a spurt in FDI, which is the proximate cause, like you said, of the reserve going over $1 billion. So clearly, that one could see from the news items, etc. So let me explain the other three factors. I think others can discuss the immediate situation. So the three underlying factors we have to remember. One is that the global economy has been slowing, and with all that implies for exports, export demand, prices of importables, etc., etc. The second factor was, which would tend to have a negative effect, but the second factor is the oil, right? So when the economy slows, oil prices tend to go down. But this time there was an additional factor. There was the politics of oil, where Saudi Arabia was very upset with Russia, and in some sense took the prices even below what would normally have happened in any case with the slowing of the global economy. So this one clearly benefits us, has benefit, and will continue to benefit throughout the year, so to say, as long as global economy is. And I've often pointed this out, that even though the remittances from oil exporting countries go down, even though our exports go down, on balance, on average, our balance of payments tends to improve because of the oil factor overall. And finally, the third factor, of course, is that because of the lockdown, it meant 60% of the economy roughly was closed down, and most of the oil consumption is actually the only part which was functioning was the essential commodities, where basically the bulk of oil demand is indirect through fertilizers, etc., which are inputs into the essential, agriculture and other sectors. So with this economy closed down 60%, the demand for oil imports was down. So we will continue to see those effects. But like you have pointed out very, very correctly, the big spurt in reserves right now is because of this huge capital inflow.
Okay, all right. So, Mr. Dasgupta, the two previous speakers have spoken about history, taken us back to the late 80s and early 90s. I'm also going to talk about a little bit of history, but not go back so many decades, but go back only about 9 months. In September of last year, of course, there was this decision to cut the corporate tax rates. So how much of an impact do you think that has had really as far as our Forex reserves are concerned?
I think the foreign direct investment flows which have taken place, because that was the corporate tax rate cut was meant for new investments. So it should have then got reflected in FDI flows. But the FDI flows that have taken place have been localized, I think, in the past month and a half or so. And that too because of the Reliance and the Airtel deals mainly. So I don't think the FDI flows have really been influenced very much because of the corporate tax rate cut in September last year. Of course, it is a very short span of time during which to judge this measure, and it needs a longer time span. So that having been said, the factors which have been mentioned by the previous speakers, the oil bill has come down. There has also been another significant reason for the increase in the foreign exchange. One of the things is that apart from oil, our other imports have also come down quite substantially because the industry has not been working at full strength. And so the demand for raw materials, intermediate products, for the pharmaceuticals industry, for the electronics industry, for instance, and a host of other industries, the gems and jewelry industry, we import a lot of rough diamonds, for instance, all those things have fallen. So that has led to an increase in the foreign exchange reserves. The last point I wanted to mention is that foreign outward remittances have also gone down. And in the last 10 days or so, foreign institutional investors have come in a big way. And I think in 1 week alone, about $2.75 billion was invested in the Indian stock markets.
Okay, all right, taking the discussion forward now, let's talk about the significance, Mr. Tripathi, of rising Forex reserves and what does it really mean for us and for the economy?
You see, a larger foreign exchange reserve gives stability to the economy against any external shocks. And, now we are sitting on the third largest. The largest is $3 trillion of China, and more than $1 trillion is Japan. Thereafter, I may be wrong, but I'm told India with $500 billion is about third or fourth. So a country of India's size and Indian economy is also growing steadily. It may be fifth, sixth, or seventh, or it has potential to become third. So, it insulates us from the external shocks, whether those shocks are due to a very high rise in oil prices, or maybe some, obstruction in trade, or maybe a war-like situation or some such thing, and also gives strength to the economy to take risk also, whether we are taking risk in terms of foreign exchange investments or making investments outside India, because a situation has come, particularly in oil sector now. You see, we are not given to a very good geology. Our reserves are less than 1% of global reserves, but our consumption of oil and gas will keep increasing, at least in the foreseeable future. So we need to go outside to places which have oil reserves and buy those reserves. So like China has been doing for the last 15, 20 years. Similarly, our companies have to go outside and set up companies where the markets are, whether in USA or in Europe or even in China. So these things can be now more easily done with a larger base of foreign exchange, because you first initially you make investments and then your investments start giving you fruits. You see, Europe, what did Europe do? Europe made investments in the 19th and 20th century. Today, Europe's economy, particularly Britain's economy, is dependent on the investments made in the past. So for maturing economy, and we are from a developing, going towards a developed economy, it will take some time. But we can, we are quite mixed. We have some signs of developed and more signs of developing economy. And China has been doing this. China has been investing very heavily in Africa, in Southeast Asia, in Latin America, also going into Europe in a big way. So we have to also look at those things, and this gives us greater stability, greater strength, and also in the domestic economy, it gives us strength because our currency can be more stable. The Reserve Bank can play a role of stabilizer of currency with greater confidence. So all these factors are plus factors.
Absolutely. This is one point that I want to take forward with you, Dr. Virmani, this issue of the Reserve Bank that Mr. Tripathi just raised. So how do these Forex reserves really help the government, and more specifically the Apex Bank?
So one has to, sometimes one sees discussions, common discussions, which don't display a understanding of the meaning of the word reserve, right? I also happen to have been, actually that was the only top secret thing I ever did. I was part of the reserve management information, which is top secret, by the way. So the whole concept of reserve is that it has got to be there in a liquid form. Okay, otherwise it's not reserve. So you will start to hear these conversations which are completely wrong. Either you don't have reserve, but if you have reserve, you can't use them for some other purpose. So, this concept of reserves is still not understood by people. Either don't have the reserves, which is fine. You'd say what is optimal. But if you have reserves, you cannot say the central bank should lend it to X or Y or government to use them for some other purpose. It's like a complete contradiction of the term. Okay, so that is one thing I would warn against. You will start seeing this discussion in the press and on TV. The second point is which Mr. Tripathi has quite clearly made, but I'll just summarize it from an economist perspective. So, what the reserves do for the RBI is that the fluctuations in exchange rate naturally go down because people know people who would move money in and out to speculate against depreciation or appreciation know that there is so much reserves that it's going to come back to some normal level, which it should be. So the fluctuations go down naturally and the need for RBI intervention then reduces. So that's the second point. And the third point is the issue, I'll broaden the discussion. Again, it's already been mentioned, Mr. Dasgupta perhaps will take it forward. But the issue which comes up when we have more than enough reserves is it a time for further capital account liberalization? So I would say that perhaps it's worth thinking about. I should say that I have not clearly thought of this issue in detail, but the strategy which we had, which is still valid, is that more fixed type of investment like FDI inwards or outwards to liberalize completely now. If there are any restrictions, you should not have them. Of course, one can always have reporting requirements because of this problem India always has of corruption and this and that. That should be taken care of by a good reporting requirement. But perhaps going further than FDI into certain other areas, unfortunately, I have not looked at the detail in the last year or two, so I can't say, but I think exactly I can't give you examples, but I think the time has come to perhaps think of further liberalization. Current account.
Okay. Time has come for further liberalization is what Dr. Virmani is suggesting. We'll talk about how do we make best use of our reserves in just a bit. But before that, since we're talking about reserves and the RBI, a basic question comes to mind, Mr. Dasgupta, about what the RBI does with these reserves.
The reserves are basically in 4 forms. One of them is in the form of assets, which is now currently at around $463 billion. The second is in the form of gold, which is approximately $32 billion. The third is SDR, special drawing rights, and that accounts for about $1.44 billion with the IMF. And the fourth one is $5 billion odd against IMF reserves. So that is the way in which the reserves are kept. The assets, currency assets are kept, 64% of that is kept in the form of treasury bills of foreign governments, mainly the US, but other governments as well. About 28% of that is kept in the central banks, the Reserve Bank equivalent in other countries like the FedEx and other banks, and also in commercial banks abroad. And then there is a small bit, about 7.5% or so, which is kept in other assets. So that is basically the breakup of the RBI. And I must mention in this context that earnings against these foreign exchange reserves is not very high. So it is, a hedge against uncertainty. It is, as Mr. Tripathi has mentioned, to give confidence to the foreign investors, to the rest of the world that our economy is doing well. We have enough depth, and we can, fulfill all our obligations. And as far as the adequacy of foreign exchange reserves is concerned, there are 4 factors which have been mentioned. One of them, of course, is the import cover for how many months. And Mr. Tripathi has mentioned we now have more than a year's cover of imports. The second one is short-term debt obligations. And the third one is current account. And if you combine the second and third factors, then there is this Guidotti rule that we must cover for that as well. And the last one is imports. So we are well covered at the moment. But I also wanted to mention one thing, that the oil prices have shown a rising trend. Of course, they may not go up to $65, $70 per barrel, but they are around $40 per barrel at the moment. As the rest of the world's economy picks up, the oil prices may go up. The second factor which comes to mind is that our exports, we have exported roughly $315 billion worth, which is a source of inflow of foreign exchange. Now that we are uncertain as to how it will behave in terms of goods and in terms of services as well, where we get approximately $190 billion. So that is the uncertainty. And the final point most of our foreign remittances come from Indians working in the Middle East and other countries. And that accounts for about between 75 and 80 billion dollars. Now that is going to take a hit, according to some studies, to the extent of 20 to 25%. So that is going to go down. So it is very heartening that the foreign exchange reserves have crossed the $500 billion mark. But we have to be cautious, and we have to invest this amount in a way that it provides the best benefits for the economy and for the country.
Okay, all right. Taking the discussion forward now. In fact, it's a point that I wanted to raise with you, Mr. Tripathi, because you spoke about history, you spoke about your JS days, but Mr. Dasgupta has touched upon it, but still I will ask you, so is there a cost involved in maintaining these Forex reserves? Or like he mentioned, we get a small amount back. How much is that amount, and is it viable?
You see, if your currency is stable, then the central bank, that is the Reserve Bank, doesn't feel very happy keeping foreign exchange reserves. Because as has been mentioned by Mr. Dasgupta, the treasury bills of United States or maybe Germany and others give you 1% or even less return. Whereas the same money in India, if they lend to Indian banks, they will get 6-7% return. So therefore, they have an interest only as long as the currency, local currency is depreciating and reserves are appreciating vis-a-vis the currency. But now with the large reserves, the local currency also becomes more stable. And therefore, it is not necessarily, purely from a very limited point of view of return to the central bank, it is not very profitable for the central bank to keep reserves invested in government security of large countries like USA, Germany, etc. So therefore, as Mr. Birmani has said, when we are comfortable that our currency is stable and we have fairly large reserves, there is a case for opening up the economy further. There can be capital account, but before capital account, there can be investments, more liberalized regime for investments in India, liberalized regime for investments outside India. If the Reserve Bank keeps, say, $100 million in US Treasury, it's a very little return. But if that $100 million, Reliance or Tata or some very competent company goes, invests and brings returns to India and also increases trade, that is economically more profitable and beneficial overall. Therefore, and also if those reserves, for example, can be used for acquiring oil assets somewhere. So these are the various considerations that should be taken into account now. And I think, maybe the government can set up a committee now to look at it more closely and give recommendations how best we should use this situation. And, of course, there will be uncertainty. There will be uncertainty of oil prices. There will be uncertainty of economic, growth in countries and whether the growth picks up and the imports will increase, etc. But given the situation that we are today, I think it will require a committee to go deeply into it and give recommendations to the government and perhaps liberalize both investments in and out of India.
Absolutely, absolutely. All right, Dr. Virmani, your thoughts really on how do we make best use of our reserves, our Forex reserves?
Right. So I think there's a general agreement that if, first let me mention that most forecasts have seen the majority of them are actually saying that the Indian current account could go into surplus for the year FY21. I'm not drawing any positive or negative implications for the overall country, whether welfare is good or not, but that's a factual reality as far as the projections I have seen, right? So as far as, and that's all that matters for reserves. And number two, given that we already have had, for whatever reasons, we know, we have been seeing on TV that FDI for Geo, etc., but we also know that there are huge excess cash balances in the USA with wealthy individuals, right? And they are looking for outlets. So I would not be surprised at all if capital inflows actually increase during the rest of the year. So both these factors would suggest, and as Mr. Tripathi has clearly noted, that this gives us a comfort time actually the uncertainty is on the upside, as far as I can see from the BOP account. I'm not talking about anything else, right? Than on the downside. So that is an opportunity for capital account liberalization, starting, I think, again, we all agree, with the FDI part, inflow, outflow, whatever it is. Actually, it's more outflow. Inflow, there really are not that many restrictions. So it's really a question of, and the example he gave is quite valid. If large companies go out, whether to acquire technology, acquire supply chains, etc., that all actually eventually strengthens our balance of payments, strengthens our balance of trade, and therefore the long-term health. So if we are strong short-term in terms of the projected BOP plus the reserves, then that is a good time to think of of further liberalization. And number two, again, as Mr. Tripathi noted, this is something we learned over decades, was that unless uncertain, when there's not an easy answer, it's good to appoint a higher level or an expert committee which can look at all aspects. You know, the three of us here may be all experts in our own little area, but it's always good to have a committee with different perspectives, etc., which can bring in all the aspects, so you are not surprised later. So I think that's an excellent suggestion, that perhaps the government should consider setting up a committee on capital account liberalization, which can then chalk out a reasonable path which would be acceptable to the government and the stakeholders.
Right. And Mr. Dasgupta, close the show for us with your concluding remarks.
I agree with Mr. Tripathi and Dr. Virmani about capital account liberalization, because if we are more or less, sanguine that the foreign exchange reserves are going to be at least at $500 billion or slightly more during the rest of the year, then we need to loosen our purse strings and invest in profitable assets, in which companies, big corporates of India are investing abroad. For instance, in the pharmaceutical sector, we have seen a lot of investments. IT sector, we have seen a lot of investments. There may be other areas as well where people are interested in venturing into new areas and new countries and investing. That would be something for the future, which will, bring us rich dividends in the future.
Okay, all right. On that note, then I'll call it a wrap on this edition of The Big Picture. Thank you to all my guests for joining me on the program.